Welcome to this explainer. Let's jump straight in. Because today we're tackling what's honestly one of the most absolutely crucial financial transitions you're ever going to make. Picture this. You've finally done the responsible thing. You're disciplined, you're adulting, and you're moving a little bit of money into your savings account every single month. $100 here, maybe 200 there. You're feeling like a total financial grown-up. But then you hit a wall. So today, we're going to walk through the exact step-by-step path to turn those solid saving habits into true wealth-building investing. And we're going to do it without you feeling overwhelmed or risking your financial security.
So let's go back to that scenario for a second. You're saving consistently, right? But one day, you open up your banking app on your phone and you realize something kind of strange. You've got, say, $10,000 just sitting in that account. Meanwhile, you keep hearing literally everyone around you talking about investing, the stock market, index funds, compound growth, all that stuff. And suddenly that sinking feeling hits you in the gut and you ask yourself, wait, am I doing this wrong? Well, it's a totally natural question. Because look, while saving money is incredibly good and necessary for sure, saving all by itself rarely builds real wealth.
And honestly, here's exactly why that sinking feeling is completely justified. Let's look at the actual math. And warning, it's a little painful. If you have 10 grand sitting in a standard savings account, earning, let's say, 0.5% interest, do you know what your grand reward is after leaving it locked up there for an entire year? $50. That is it. That's barely enough to cover a few fancy coffees. And that's your reward for tying up $10,000 for a whole year. So the big takeaway here is that saving money is important, absolutely, but it is definitely not the finish line. It's really just stage one of your financial journey.
And that perfectly illustrates the massive paradigm shift we need to talk about today. Savings and investments, they actually have two totally different jobs. The job of your savings account is to protect your money. Think of it like a shield. But the job of your investments is to grow your money. It's an engine. And if you try to use a shield as an engine, you're going to be pretty disappointed. We literally have to stop expecting our savings accounts to make us wealthy. It's just not what they're built for.
Now watch how crazy this contrast gets when we zoom out to, say, a 20-year horizon. Imagine you save that same $10,000 in an account earning a slightly better 1% interest. After 1 year, you've got $10,100. Okay, but historically, the S&P 500 stock market has returned about 10% per year on average over long stretches. If that same 10 grand earned 10% annually, you'd have $11,000 after 1 year. Now, the difference between the two doesn't seem huge right off the bat, right? But just look at what happens at the 20-year mark. Your savings at 1% slowly crept up to about $12,200. But that invested money at 10%, it absolutely exploded to about $67,000. It's the exact same starting money, but a wildly different outcome.
This massive mathematical difference totally shatters a huge myth we're all taught growing up. We're always told that the ultimate financial battle is just saving versus spending. But actually, scratch that, it's a complete myth. The biggest wealth gap in our society isn't usually between the people who save their money and the people who spend it. The real gap, the one that changes lives, is between the people who merely save and the people who actually invest. But if the math is so overwhelmingly obviously in favor of investing, why do so many people fail to cross that gap?
Well, the reason people get stuck has nothing to do with math. It's all psychology. Let's be real for a second. Saving feels incredibly safe. You pull up your banking app, your money is visible, it's static, it's just sitting there minding its own business. Investing, on the flip side, feels incredibly risky. Investments move. Sometimes they go up, sure, but sometimes they drop 5% on a random Tuesday afternoon. And that emotional volatility, it absolutely terrifies people. If you're sitting there right now thinking, look, I do not want to lose the savings I worked so incredibly hard for, that is totally fair. Honestly, that psychological fear is exactly why you shouldn't just dump all your money in at once anyway. Which brings us to the roadmap, transitioning without panic. Let's look at exactly how to cross that gap in deliberate, completely manageable stages. So here are the 4 steps of our roadmap. Listen, before you even think about investing a single dollar, step 1 is an absolute non-negotiable. You must build a real emergency fund. You need 3 to 6 months of living expenses saved in cash. And this money stays in savings. It is not for investing. It's strictly for unexpected life stuff, a job loss, crazy medical emergencies, or, your car's transmission suddenly exploding. And here's why this matters so much. The number one reason people panic sell their investments at a loss is simply because they need cash immediately. Having a fully funded emergency fund literally protects your investments from your own life. Now, once that emergency fund is locked in, step 2 is this mental trick that is an absolute game changer for reducing anxiety. You need to mentally separate your saving from your investing by visualizing two distinct buckets. Bucket 1, that's your safety money. It's your emergency fund. It does not move, period. Bucket 2 is your growth money. And because you know your safety is 100% secured over in Bucket 1, you can actually give Bucket 2 permission to fluctuate. Its one specific job is to ride those market waves and grow over time. Seriously, setting up these two mental buckets dramatically drops the emotional attachment and the fear you might have about market swings.
All right, on to step 3, start small. A massive misconception that really holds beginners back is this idea that you need thousands of dollars to even start investing. You absolutely don't. Do you have 50 bucks? Because if you do, you can literally be an investor today. So many brokerage platforms let you start with just $50 or $100. And remember, when you're making your very first investments, the goal is not to somehow generate massive, life-changing profits on day one. No way. The goal is simply to build the habit. In the beginning, just establishing that routine of investing matters way, way more than trying to perfectly time the market.
Which brings us to step 4. Focus on simple investments first. Look, beginners often make this huge mistake of jumping straight into super complicated, really stressful strategies, like day trading, options trading, or trying to guess the next big crypto coin. But here's the secret. The simplest investments actually often outperform the complicated ones over time. Enter the index fund. Instead of trying to guess and pick one single winning company, an index fund lets you invest in hundreds of companies all at once, basically tracking the entire market. It gives you instant diversification, way lower risk, and steady long-term growth. Honestly, it's so incredibly effective that legendary investor Warren Buffett has repeatedly called low-cost index funds the absolute best strategy for most normal investors.
Now let's take a look at the true power of a totally boring but consistent investing strategy using something like those index funds. Just imagine you invest a fairly modest $300 every month into the stock market. If the market averages an 8% return per year, fast forward 25 years, and your account would be sitting at roughly $285,000. But look really closely at the breakdown here. Out of that massive total, you personally only contributed $90,000 out of your own pocket.
The rest of that balance? Almost $195,000 came entirely from investment growth. That is literally money generated out of thin air, simply because you allowed the absolute magic of compounding to work in your favor over a long time frame. Your money went to work and made money, and then here's the best part, that new money made even more money. It's incredible.
But of course, we have to talk about the elephant in the room. Psychology still matters, right? And even with all this math completely on your side, you're probably sitting there thinking, okay, this sounds amazing in theory, but what if I start investing and the whole market crashes? Look, it's a really great question. And the very first thing you need to know is that market crashes are completely, entirely normal. They have naturally happened dozens of times throughout history. The news headlines are gonna get dramatic, and unprepared people are definitely gonna panic.
But here is the absolute key insight that separates the experienced investors from the gamblers. Long-term investors actually benefit from downturns. Think about it like this. If you're investing consistently every single month, well, when the markets drop, your monthly contribution suddenly buys way more shares at a much lower, deeply discounted price. You are essentially buying stocks on clearance. And that often leads to incredibly strong returns later when the markets inevitably recover. Experienced investors, they stay calm during all that volatility because they're thinking in decades, not in days.
You can think of saving your money kind of like storing seeds in a glass jar. You're protecting them, you're keeping them safe from the elements. But inside that jar, absolutely nothing is ever going to grow. Investing, however, is like taking those exact same seeds and planting them out in the soil. Now, at first, it's messy. You bury them in the dirt. You don't see any immediate results on the surface, and honestly, it might even feel like you've just lost them. But over time, with patience and discipline, things sprout. They grow, and eventually you get to harvest something massively bigger than the tiny seeds you started with. So, as we step back and look at the whole picture of this financial roadmap, we really arrive at this fundamental truth. Saving money is what gives you stability in life. It keeps the lights on when things go sideways. But investing money, that is what actually gives you freedom. It is the engine that builds your future wealth. And the earlier you master this transition and get both of these stages working together, the more powerful your financial future is going to be.
Which brings us to our final thought for this explainer. I really want you to take a close look at your own accounts today and ask yourself honestly, are you just saving or are you actually investing? If you've got your emergency fund secured, but the rest of your cash is just sitting in a jar earning a fraction of a percent, well, you now have the roadmap to safely start planting those seeds.
The incredible power of compounding is literally just waiting for you. Thank you so much for joining me for this explainer, and I really hope this helps you take that exciting next step.